the syllabus by the AAT. So if you have a very early version of our materials, you'll need to access the errata sheet where we've added in this section to teach you what an LLP is. So an LLP is a bit of a hybrid really between a company and a partnership. So what we mean by that is that it has some features in common with companies and some features in common with partnerships. We would say that it's most like a company, and the reason for that is two key things. Firstly, that it is recognised as a separate legal entity, and secondly, that it gives the owners of the LLP limited liability protection. So both of those features we have in common with a company. So let's just remind ourselves what we mean by that in a bit more detail. Because it is a separate legal entity, it can own assets in its own name. So if it owns a building, it will be owned in the name of the LLP rather than in the individual people who are involved in the business's names. It can enter into business contracts in its own name. It can sue and be sued in its own name. It won't be the individual people behind that business whose names are on those contracts or those agreements. It also means that the people who are running that LLP get that limited liability protection like they would if they were operating as a company. So if the LLP can't pay its debts, the owners are protected from people suing them personally for their own money and assets. You'll see quite a lot of accountancy firms and legal firms are set up as LLPs because historically they always used to operate as partnerships, but we know that operating as a partnership can be quite risky for the owners. So by operating as an LLP, they sort of retain that historic status that they used to have as being a bit like a partnership, but they have that limited liability protection for the partners. There are a couple of ways in which it differs from a company. So one of the major ones is the owner-manager split. We know that when operating as a company, there is a clear distinction between the people who own that company, the shareholders, and the people who manage that company, the directors. Now, okay, they might sometimes be the same person, but they're two key different roles that they are performing there, and a really important split is maintained between those roles. With an LLP, it's not like that. The partners of the LLP will be both the people managing the business day to day, and they will be the owners who've put the money into the partnership. So, in that respect, it behaves much more like a partnership than a company. The other key difference is in the way in which the LLP is taxed. So, it's taxed like a partnership rather than like a company. So what we mean by that is that the LLP itself would not pay tax on its profits. It certainly wouldn't be paying corporation tax because it's not a company. It's the partners of the business when they share out those profits. It's the partners who pay income tax on their share of those profits. So that's very much like a partnership. Just looking at a couple of legal aspects. It's the Limited Liability Partnership Act 2000 is the piece of legislation that governs how these entities operate. They are required to be registered at Companies House in the same way that you would register a company. And they also do have to file their accounts at Companies House. So their results are on public record. Now, we've given you lots of information about the different business structure types, and so what we have here is a little summary, which could be quite useful for you in your revision. So just looking at some of the key features and how they differ between sole traders, partnerships, LLPs, and companies. So as a reminder then, how is the entity formed? So for a sole trader, no formal process at all, just decide you're going to start trading. For a partnership, you need some kind of partnership agreement. Now, that can be a formal agreement, which is drawn up with a solicitor, or it can be very informal. It could just be a verbal agreement between two people. That's it. Then you can just start trading. So there's no registering with Companies House like there would be if you were an LLP, or if you were a company and you have to follow that formal process. What's the legal status of the entity? Well, we can draw a line down the middle here, really, can't we? Our sole traders and partnerships have no separate legal personality from their owners, whereas our LLPs and our companies do. Next, we talk about how ownership of the entity is transferred. So if the current owner of the business wants to transfer that to somebody else, maybe they're retiring or they're selling up and passing that on to somebody else, how would that work? So for a sole trader, there's no special formalities at all. You just either give it to somebody else or sell it to somebody else, all the assets and trade of your business. With partnerships, it's a bit more complicated. So you can transfer your share of the firm to somebody else. So that means your right to a share in the profits, your right to a share of the assets if the partnership is wound up. But crucially, what you can't do is transfer your right to participate in management. So if I were to pass my share of a partnership onto my daughter, she would have the right to have any profits that she would be entitled to and any share of assets, but she would have no right to take part in the day-to-day running of the business. She wouldn't be able to get involved in the decision making, unless, of course, the other partners wanted to welcome her into the firm. How does it work with an LLP? Pretty much the same as with a partnership, so same sort of situation really. You can transfer your share in the firm, but again, you can't transfer the right to get involved in managing the LLP unless the other partners agree to that. With a company, we're talking about selling the shares to somebody else. So the way that works will depend on whether we're dealing with a limited company or a PLC. Now, with a limited company, you would have to find somebody else to buy your shares. You couldn't just sell them to any member of the public, like you would be able to trade PLC shares and just sell them to somebody else that you might not even know, perhaps on the stock exchange. With a limited company, you would need to find another person to buy those shares off you. It tends to be somebody that you know that you would be transferring that business to. Any of you that deal with shares on the stock exchange will know that you can freely trade those shares to somebody else. You can sell them publicly, and it's usually quite an easy process to do. What about number of members? So for a sole trader, the clue's in the name sole, it would be one person. For a partnership or an LLP, you'd need to have at least 2 people involved in that business. With a company, you can just have one shareholder. Often we will see little owner managed companies where the shareholder is also the director, and that's okay. Obviously, it's a minimum of one, so often you will have more than one shareholder of that company. Who runs the business? So when it's the sole trader, that person is the manager, is the person taking the key decisions as well as being the owner. With a partnership, all partners would be getting involved in the day-to-day running of that business, unless somebody is specifically excluded from doing so. Perhaps in this situation we talked about above, where they'd acquired their share of the partnership from somebody else and didn't have the automatic right to get involved in management. Same situation with LLPs. With a company, as we've already discussed, just because you're a shareholder, you don't automatically have any right to get involved in the day-to-day running of that company. You would only be able to do that if you also held the role of director within that company. And then finally, are the owners of the business liable for the business's debts? So we know that with a sole trader, the owner has unlimited liability, meaning they are fully liable for the business debts as well as any personal debts. Same situation with a partnership. The partners have unlimited liability for the partnership's debts, so they would need to step in and cover those debts if the partnership couldn't afford to pay. Whereas we know that with LLPs and with companies, we have that limited liability protection. So again, we can draw a line down the page here. Slightly different in terms of how that works. So with an LLP, the liability is limited to the capital that the member has contributed to the LLP. So, think about a member buying into a partnership. It's whatever money they have introduced into that partnership is what they stand to lose. Whereas when we're talking about a company, that limited liability is limited to the share capital amount that member has contributed. Okay, so useful little summary there for when you're revising.